That was the management of Tata Consumer, the MD and CEO, talking to Aisha Faridi on the forward-looking plans as well as the numbers, the earnings picture, and the plans, business expansion, and on tariff front as well. But now let's shift focus from the technicals and talk about the larger picture of the market. Try and understand and navigate the portfolio management strategy. And for the same, we have a market expert with us. We are joined by the CEO of Helios Mutual Fund, Dinshaw Irani. Dinshaw, good morning. Mansi this side. It's a pleasure talking to you this morning.
Mansi, thank you for having me on your show, and a very good morning to you and your team and the viewers.
Absolutely. To start with, yes, a lot of uncertainties coming from the global front. Trump tariff and tantrums ongoing, but less shockers, at least in the last 2 days. And whatever announcements and developments are coming in are a cheer, at least for the US markets, and of course, an eventual impact on the markets across the globe as well. What's your take on the domestic market at present?
So, Mansi, basically everybody's awaiting the trade deal. I think it's a matter of time before India also comes into the fray. I mean, you've already seen quite a few trade deals happening with the US. Japan was the last one, which was at 15%. I think India should be somewhere in that ballpark of 10-15% if things go the way it's expected to go. That should be taken as positive by the market. But I think the market's already built that into its stride. And that's why, despite all the negative news which has come in, the market has been fairly resilient. And resilience is basically because of this fact that one, valuations are looking fairly, I would say, reasonable, but they're not looking stretched either. The only negative part is obviously the quarterly numbers. I mean, we did some quick data analysis for the numbers that have been reported thus far. Probably it was a day-old stale data that I have. Not looking good. For the June quarter, the numbers are not looking good at all. The single-digit growth in top line and 7-8% drop in the bottom line. So I think that is what is holding back the markets, if anything. But our feel is that come September, actually very ironical, there's a song also called Come September. But anyway, the fact is that come September, we expect that the base anyways has dropped for a YOY comparison. And as a result, you'll start looking at healthy type of earnings growth. And frankly, I mean, the green shoots that we take away is probably one of the results that came out yesterday, one of the consumer companies, and they were calling out an urban recovery. So I think that is what is awaited. So we don't expect the markets to go down. If anything, the best case scenario, I mean, the realistic scenario for us is probably a time correction, a sideways movement in the market. And from there on, it will be a call on the earnings growth and how things move from there.
That's interesting, Dinshaw. We'll try to deep dive more into your take on the consumption space right now. But before that, Dinshaw, like I've been flagging off that the markets are on the upward trajectory despite all the negative news flow. But Dinshaw, with respect to the trade deal between US and India, what number do you believe that the market is already pricing in? Because from those 26% that was announced, what is your analysis that which number will be taken positively and which number is already digested?
So basically, if it's 26 and above, it will be definitely a negative for our markets as such. But my feel is the way things are working out, I think the red lines are being drawn by us rather than by the US. And if we just back off a bit on the red lines, I think we'll be in the ballpark of 15, 20 odd percent, which will be taken as very positive by the market. And basically, I don't have any knowledge yet, but inside knowledge as such. But I'm just taking off from what has happened with, say, Vietnam, with Japan, and with other countries which have recently announced, Philippines and all that, which have recently announced. It's in that ballpark of 15, 19%. So I think we should be there somewhere there as such. And that should be taken as positive by us. Frankly, I think the red line that we have is obviously the genetically modified GM crops, which are a total no-no for us. I don't think they're also that keen on that. So let's see how that works out. But this would be what our call would be.
So all eyes are going to be on where that number finally settles once we do have a definite announcement, and we don't even know when that is going to happen. But then, Shah, morning, as much as we like your glasses, what are you liking in the market right now? Only purely from a valuation standpoint, if we keep aside the earnings, given that we have been so range bound for the last couple of months, anyway, you believe valuations have cooled off significantly to merit a fresh entry, or on the flip side, anyway, you believe valuations still look rather stretched?
So basically, okay, before I start off, by the way, these are the glasses which have held up the markets according to Samir. Because I changed my glasses in April, and from there the market has been fairly steady and up, in fact, at some point in time. So having said that, actually you're right in the sense that bulk of the results which have come out thus far are not looking that exciting, right? Look at IT. The best of the pack probably reported yesterday, which was Infosys. And they called out a better first half as compared to a second half. So it's obvious that from here on, they're looking at a degrowth, not degrowth, rather they're looking at a dip in growth rates happening, and anywhere 2.2, 2.3% constant currency growth is not an excellent growth to talk about. And we've been calling this out for a while. We've been calling out that the markets will be sideways, if anything, range bound, if anything. And that's why I'm looking at probably at September quarter, hopefully, because September last year was the worst quarter that we reported. I think it was a down dip of 8 odd percent in earnings in that particular quarter of September 24. So the base anyway is lowered from here on, right? So there was an 8% dip, then there was a mid-single digit growth in December. Same was the case with March. And I think I don't see any difference in the June quarter. If anything, it'll be a mid to low single digit kind of growth in earnings anyways. So anyway, your now base has been set. If anything, from here on, and looking at the way RBI has infused liquidity in the system, normally liquidity finds its way in form of consumption to the other or the other way around, because cheap money is what is needed by the consumer, and that is what is, I think, is what we're looking at. And probably if that uptick happens, then you'll see September quarter, if it continues to remain as the June quarter numbers, you'll see September reporting a double-digit growth. Even if it is a flattish quarter for, as in same quarter, June numbers reported there. So you look at a double-digit growth. And from there on, if consumption picks up, I think that is what is awaited. And probably you'll see, again, interest coming back in stock-specific names and all. By the way, despite all this, we have enough names to work with. We have enough ideas to work with. In fact, some of the ideas we picked up recently are looking fairly exciting. And you'll see them when my portfolio comes out. I mean, even in this market, we get ideas. So it's obvious that if it's a diligent investor, he's definitely going to choose this opportunity to take bets going forward. And actually, consolidation is the best phase when you can identify new ideas and pick them up.
I would say keep wearing those glasses, because if you say so, it's really helping the markets then. But moving ahead and talking about the auto sector, I would want to understand your view, and not just auto. When I say auto, I mean auto ancillaries as well. And the India-UK FTA, the agreement is in the signing stage anytime right now. And of course, there are a lot of products which we are eyeing, but in particular, India is planning to lower tariffs on UK cars and also to cut average tariff for UK goods to 3% from the 15%, which was planned earlier. So in the same lines, what's your view on the automobile sector? Not just this news flow, but other than that also, the auto sector is trying to help the market quite a lot.
So, Mansi, we don't like the auto space at all, basically because we believe that not only, obviously the demand collapse was mainly driven by urban collapse in demand and the tight liquidity condition. But even going forward with this liquidity coming into the system, we don't expect that sector to do well, because now there are more options available in that segment. We're talking about basically EVs. And frankly, EVs, you've seen that play out in the two-wheeler space, how the two-wheeler segment got romped over by EV guys. The growth just disappeared because of EV coming into play. And in fact, if you talk about autos, in two-wheelers, this is the space we like more, the new generation EV players which are coming in. One was a recent listing where we were the anchor, and we continue to invest in that stock. The second one is Old Hand, which I think listed last year, corrected a lot. And I think that also is looking very exciting going forward. I mean, given the fact that the management is now revamping the whole show out there, I think that's another sector to look at in the EV space. In the PV space, as I said, I don't think they've seen the EV onslaught as of now. But once they do, and frankly, I mean, that is what I think the Trump tariffs are all about. If anything, they're targeting this segment per se. You saw that happening with the UK FTA. Finally, we had to come down to cutting off duties on the automobile space. I think the same is going to happen with the US. If the deal goes through, it has to be a big compensation on the auto space. So we're not too keen on the auto space, specifically the PV space.
Well, indeed, you have been not liking the auto space for quite some time now. But Dinshaw, let's talk about the consumption space right now, because from the staple side, we have seen the Q1 updates so far were decent enough to take the stocks higher. And like you were also mentioning that the consumption companies, or rather the consumer companies, are now talking about the recovery in the urban areas, which was not the case earlier. What do you make out of this? And within the consumption basket, how can investors take a part in that? Because discretionary as a play has been liked by a lot of these market participants. But what is your take? Discretionary versus staples, and if at all you like the space at all?
Actually, we don't like the two spaces. As I said, that staples, though the uptick has happened, but look at the valuations of these guys. I mean, they're already fairly stretched as such. Even the QSR space, which we used to like earlier, we still have one stock there. Apart from probably one particular pizza player, none of the others have reported good numbers. I mean, all the numbers are coming out to be pretty. And these are why I'm talking about these is because these are impulse spends. QSRs are basically impulse spends. When you go to a mall, you tend to eat something fast and you go there. So the fact is that also is not picking up, means the consumption is not that much kicked in. In fact, what I referred to, the particular company which called out these numbers, they were talking about salt, that salt has been a mainstay for them. And that growth points out to the growths in the basic staple level. So entry level staples are doing well. I think it will be a matter of time before the premium end starts moving up as such. So that is how it will work out. But frankly, I mean, looking at the valuations, we're not excited at all. I mean, giving 50, 60 Ps, forward Ps for growth rates of 10, 11% in the best case scenario. I don't think that's going to work for us. So we'd rather avoid. In the durable space again, I think AC is a big player within that. But AC is a play on basically the weather as such. And this time around, I don't think the numbers are looking too great for the AC players. You've seen that in one of the players who's reported the numbers didn't do too well in air conditioning. And I don't think that's what we're looking at either.
Dinshaw, also lastly, before we let you go, last time we interacted with you, BFSI, hospitals and tourism were the spaces that you were liking. Does that conviction continue?
Yes, definitely. I mean, I don't think we've been shaken. By the way, the numbers are pretty good. You saw the two major banks reporting the numbers. They've been taken very well by the market. And I think it was good numbers to look at. The asset growth has been good. The quality of asset growth has been good. So it's obvious that things are working out perfectly for this. On the financial services and insurance numbers, again, whichever little has been reported, we're talking about AMCs and stuff like that, they've been good numbers as such. So that continues to be good. Hospitals, as and when the numbers are reported, you'll see that the whole story about the average revenue per occupied bed, RPOB, as they call, are on the uptake. And as a result, the break-even levels for new hospitals have come off. And that is what you're looking at in this. Same is the case with hospitality. Again, looking good as such. Indian hotels, I think, reported the numbers, and they were pretty decent numbers. So I think that trend continues for us.
Dinshaw, it was quite an insightful conversation. Always a treat to connect and talk to you. Thank you so much for giving your time and
Thank you.
helping our viewers with the market analysis. Have a nice day to you.
You too.